change in a second.
If someone tweets something.
No, if the policy comes out as actually there's a suspension for 90 days and all tariffs, with the exception of China, that was an 8% swing.
I know.
If that actually happens, then you have to stay invested.
And that's the risk. Anyway, we'll get to it, but I agree.
Very difficult.
How are you feeling, James?
I don't know how am I feeling. It's kind of quite exciting in a way, isn't it, when markets do this?
That's the word I was going to use. If you're looking after people,
it can be scary, but it is quite exhilarating, and it's our job to keep calm and carry on, isn't it?
Well, if you're looking after people's money and markets are going through this and you're not enjoying it, you're probably in the wrong job, I'd say.
Yeah, 100%.
And enjoyment's not the right word, is it? It's we're here.
You're not thriving.
No, you should be. This is the days you should be jumping out of bed.
And it's getting on the phone to people, and it's responding as quickly as you can, because our email, my email box is. I don't know. Have you ever seen that film with Jennifer Aniston and who's the actor that did Pet Detective? What's his name? Jim
Carrey and Jennifer Aniston. Yeah, what film's that?
Basically, he ends up being God for a few days. You remember that? No. It's quite. I mean, I'm not sure it won any Oscars, but I always remember him sitting there. He was having to answer prayers on the laptop, and he sits there and kind of at a million miles an hour is answering them all.
Is that okay?
And then the inbox goes from however many hundreds of thousands to millions to billions, because he can never answer everything. I think it almost feels like that sometimes in these moments.
Oh, well,
you respond to loads of emails and then look at your email box and it's even busier than it was before.
Yeah. Well, should we? We've got a few things to talk about, Easy. It's just the two of us today. Do you think we should?
It's a shame it's not episode 50, really.
Yeah, it would be a milestone episode, wouldn't it? We were just debating a title, Tariff-ied Markets. So that was quite a good one.
I think that's superb.
Yeah, Trump tariffs and the end of the world. That was
Tariff-ied Markets.
Tariff-ied Markets. There's also another one I just saw here as well.
So Microsoft does still have a business despite tariffs.
Trump tariff top trumps was another good one. Tariff top trumps.
That's quite good.
Yeah. We'll work on that afterwards, won't we? Yeah. Happy? We got an hour.
Yeah. How are you feeling?
Exhilarated, but tired. Yeah, no, because it is quite tiring. It is on your mind.
What didn't help was my daughter waking me up at 3 a.m. because her duvet had fallen off her bed.
Classic.
Hello, daddy slave. Can you come in and put my duvet back on me, despite the bed being all of 10 inches above the floor? There we are. It does take you back though. You spend the day kind of looking after a lot of money and having huge responsibility, and then you go home and like that, your 4-year-old changes you in a second. So they're good. It's half term at the moment, so. Do you know, it is lovely getting home to something. They have no idea about what's going on in the world. It's just what's in front of them and the joy that they can get from
Easter holidays.
They were crafting when I got home last night. Nice. They're making woolly sheep with material, kind of threading it through, and you get home and help them with that. It's very sweet.
George was on his holiday camp and they did some sort of flower picking, and then they stuck flowers on the front of a card, daisies and buttercups and all that sort of stuff.
Very nice.
Well, there we go. But no, Easter holidays. So Easter's coming. Lots of people off on holiday, actually, is the other thing I've noticed as well, given it's the holidays. Which is, these things tend to come at bad times. But we got some charts and we've got some bits to talk about.
Let's chat.
We get chat. Hello, everyone. Welcome to Quilter Cheviot's Taking Stock After the Bell podcast, episode 49, titled TBC, but Tariff-ied Market seems like a pretty good start. Joined solely by James Hughes, friend and colleague, investment manager. James, welcome.
Thank you very much.
Good to be here.
Exciting day, isn't it?
We're going to kick off with my favourite chart and your colleague Lawrence's favourite chart.
Yes.
Which is a little emoji chart about the emotional roller coaster of investing. And It goes up with optimism, excitement, thrill, and peaks at euphoria. And then you get anxiety, denial, fear, desperation, panic, capitulation, despondency on the way down. And then it starts recovering again with relief and hope before getting back to optimism. And the point really is that markets kind of send us on this emotional roller coaster. And from our perspective as professionals, the idea is that we need to try and put our emotions to one side and act act in the best interest of what we're trying to achieve, keep us on the straight and narrow so that we're not making bad decisions that can harm returns. As we were just sort of saying in before we press go, really, where do you think we are today, and how do you think that, I mean, it's been a pretty quick move, right, in the last week or so.
I think that's what makes it more difficult now is markets are so quick to move that by the time the news has hit, the computers or algorithms, the hedge fund setups that people have, then the prices have already moved in front of you. So
very often the last few days I'm going to say the market has moved, and then I'm scratching around, well, what's the headline? There must be a headline somewhere. And that's exactly what's been the case for the last week or so.
So it's quite, there's not the time to think about the impacts. I think less so today than there was decades ago when the news came out and you had a chance. But I think if we go back to what's happened, it's those extreme moves that really panic investors. I think I completely understand it if you see the headlines and then log into your portfolio or the new app that we have, and you see in monetary terms big falls in value, that can be pretty scary. I think we spent, if we're going back to this roller coaster, the last few years we've probably been in the excitement and thrill period, haven't we? Maybe
not every bit of every market is in every, but certainly you can look back with the benefit of hindsight and say that certain areas were in euphoria. But
I think the hard thing is one person has such a major impact on markets, and that's unusual, really unusual. I mean, usually it's economic data starts to roll when we meet companies. We get a sense that maybe sales are slowing, or it's just harder to get new customers. The consumer looks under a bit more pressure, and the cycles are long, and we get indications of what's happening. I think the market was expecting tariffs of some sort. I'm sure some
10%,
people.
I think a lot of people sort of saw 10% across the board, or maybe slightly worse for China. And I think what sort of set this off was at the level of tariffs on a alleged trade-weighted basis near to 25%, which is a lot.
I think 2 days before there was a rumour that it was going to be 20% across the board, and that felt, I think the market thought that was an exaggeration. And I remember saying to my colleague Lawrence, who I work very closely with, gosh, if it's anything like that, the market is going to really sell off. But it's a rumor, and we didn't believe it based on what had been said in his campaign trail, etc. But obviously he came in with a blackboard and a piece of chalk, and different countries, and those levels were higher than we anticipated.
And then the 54% on China. But I think what's really spooked the market today and yesterday is the additional, what are we at, 104% for China, which is...
And they've just retaliated with an 84%, haven't
before
they?
We've pressed go, so which doesn't affect. I mean, there's not a huge amount of US export to China, but it's the fact that they're not backing down, and we're in full-on trade war. So just in terms of some of the direct outcomes, we're gonna US equities are here in yellow. Year to date, the US equity market is probably down the best part of 20%. It probably will be 20% by the time today is closed. We'll see how that goes. So that's in yellow. Europe and the UK in grey and blue respectively. Actually, Europe to last night's close was flat, albeit it's down today. So European equities had a really good start to the year and were really strong through February, but have given most of that back, obviously, in the last couple of weeks, or last week or so. And then sort of emerging markets, and Japan is there, is at a pretty rough time as well, isn't it? So a real sort of mix, but US definitely lagging, and that's pretty obvious. When Apple is probably one of the kind of best case studies of a stock. Might put the Apple share price chart in, but essentially what Apple produces 90% of its iPhones in China. It basically costs Apple $500 to make an iPhone. And if they've got to pay a 50% tariff, they've got to pay $250.
Yeah.
So, the question really is, Donald Trump would say that China is going to pay the tariff. However, that $250 on each iPhone probably going to be split between Apple's profits, reduced volumes, and higher prices of iPhones in US shops.
I think it's anticipated that if the tariff stays as was initially put in, it would be almost a 20% hit to earnings per share. And the market cap it's lost since the start or the tariff announcement is the equivalent to the whole value of JP Morgan, the US bank. So
it's about a third, isn't it?
Yeah. So these numbers are
enormous,
absolutely enormous.
But there's two companies really that if we want to kind of get into the detail, Apple is one of them, as I mentioned. The other one's Nike.
Yeah.
So a lot of companies back in 2016, 2017, 2018, in the first trade war, when Trump was first president, deliberately moved their manufacturing operations.
Well, they were encouraged to by the by previous administrations. So, as you said, Nike were encouraged to move operations from China to Vietnam,
Cambodia type. And of course, those countries haven't been spared either. And in fact, I think Vietnam is 75%. It's a pretty high one on Vietnam. So the Nike share price again is, been hit really, really hard. It's down probably 30 odd percent, and it had already been weak into it. So the share price chart looks pretty old. We're not going to show that one because it's not good. But it's just fascinating. You start picking away. Well, okay, because it's going to cost more to make Nike trainers to get them to America. Who ultimately pays that? And it's probably a combination of Nike's profits and higher prices for trainers in the shops.
Consumers, yeah.
So,
I mean, I did hear that if iPhones were solely produced or manufactured in the US, an iPhone would be $3,000 an iPhone, and I'm sure a pair of trainers would no longer be $150.
Well, it's not practical to make iPhones in America tomorrow. It's going to take years, years and years to get up and running. But we're not here to really discuss the rights and wrongs of the policy, are we? The policy is the stated policy, and the market reaction is what it is. It's since the start of the year, the equity market looks pretty horrible, especially in the last week or so. We zoom out a little bit. I've got a chart here going back, various equity markets going back pre-pandemic. And yes, a lot of those gains have been given back, as you can see. But, the equity market had a pretty strong run in the last 2 years in the US. We've talked ad nauseam about the likes of Nvidia and the AI boom, and Apple and Amazon have all been really strong. It's another kind of setback on the journey, isn't it?
It is, but I think, if you expanded this chart out further, the big sell-offs are tiny in the grand scheme of things. And bearing in mind, we went through a global pandemic, in 2020 and how quickly markets recovered from that. And then, 2022 or, 2021 was when rates started increasing. 2022 was very difficult in terms of performance because interest rates basically went from 0 to 5%. And the valuation of businesses is adjusted quite quickly. That was a really tricky period. And actually, if you look at the performance of equity markets and businesses, they performed, they got back and recovered fairly quickly. We're in the eye of the storm at the moment with the tariffs, but you could sit here and say, well, this is different and, this will set us back X number of years. But I think when you're in the eye of the storm, it is quite difficult to look outside. And I sort of feel, this is almost a binary event in some ways because, the administration could come out or Trump could come out and say, there is a 90-day delay in enforcing tariffs or, whilst negotiations happen. And I think, with the exception of China, because that is just an ego trip and neither side can be seen to say, to lose face. I think, with the others, this is a starting point, and I would expect on all those tariffs for things to end up better than where they were originally announced. So it's if you did if you did change equity allocation and got very defensive and sold off a load of assets, I think that rebound could happen very quickly. And it's not a case of you're in the middle of a financial crisis and it's going to take years and years to rebuild and for people to have confidence again. The tariffs can be turned off or renegotiated very quickly.
It's entirely man-made in that sense.
Exactly that. And it's really unusual for global markets to be impacted by the view of one person. I mean, we haven't really had a historical event in comparison, have we?
No. No, and even the 1930 set of tariffs that were impacted were on the back of a stock market crash and an economic recession that was then made worse by the tariffs.
Yeah.
So I totally agree. I mean, if you decide to reduce your risk meaningfully and sell equities because you're scared and you think it's going to get worse, that's fine. But be very aware that you might miss out because he might change his mind today or tomorrow. He might even change his mind by the time we end this pod. And that's the risk that you run at the moment.
Well, one question I'm being asked by clients, so I'm going to ask you the question as well, is what is his rationale behind these tariffs? Why does he think it's a good idea, and what's he trying to achieve from them?
He thinks that having a trade deficit with anyone is bad news. Now, I go to the coffee shop every morning and I give the coffee man £2.50. So I have a trade deficit with the coffee shop, but he supplies me a good that I want to buy. Conversely, I come to work and work pay me to be here. And therefore, I have a surplus with work. Come on, easy. And I have a trade surplus of work. And that is kind of how the economy works. The US buy things from China because China have things that the US consumer wants to buy or whatever it is. But he somehow simplistically thinks that a trade deficit with anyone is bad and therefore tariffs are the solution to it. But it's almost like he has a kind of zero-sum game attitude to trade and to growth. And it isn't a zero-sum attitude. It grows the pie trade. Now, you could kind of argue the US do have lower tariffs on everybody else than everybody else has on the US. But that's kind of in the US's benefit because the US buys more stuff from everyone else. So it's a kind of deeply held belief that he's got, I guess. You can kind of argue that the dollar's artificially strong because people want to park their money in the US. And that's the flip side, and we'll come on to talk about we'll talk a bit about that later on. But the flip side of having a trade deficit, i.e. buying more stuff from the rest of the world and the rest of the world buys from you, is that the rest of the world park their money back in your country. They buy your bonds, they buy your equities, they buy your property. And that's kind of definitional.
I mean, it's something that Warren Buffett has talked about for a long time, in his annual newsletters about the trade deficit and how it does need to be evened up and how essentially you're selling off, the country's assets and the crown jewels. And the theory of it, I do understand. But he the other part is, I think, the US's outstanding debt, which we've spoken about on lots of occasions on this podcast, is unsustainable. And the direction is unsustainable and it does need to be addressed. And what I can't understand is why Trump believes that evening up the trade deficit will help on the fiscal side. I mean, yes, tariffs mean extra revenue, but that's on the assumption that that people carry on buying and selling in exactly the same way despite massive tariffs being put on. I don't believe that. I think consumer habits change and businesses will change. They'll manufacture from different places, or demand will come from different places.
I kind of get it fundamentally that maybe you should make stuff that you consume in your own country, but America's got a big trade deficit. UK's got a big trade deficit as well in a sort of relative terms. But America is the wealthiest, most dynamic, highest growth, most revered economy in the world with one of the greatest set of capital markets. And you could say in spite of or because of its kind of trade policy. So, it's hardly, but they've got some issues, and the fiscal deficit is one of them. But this doesn't necessarily, this seems like the wrong solution to the wrong problem to be focusing on is my opinion. But
I think the way he's gone about it as well is just completely the wrong way. If he wanted to even up the trade deficit. There's one thing to have negotiations behind closed doors with individual countries. Standing up there with a chalkboard, one evening is just, it's the rhetoric is completely wrong, and that's why it's complete uncertainty, and that's why the market's done what it's done.
Well, that's an interesting point you raise about the market doing, because actually, if you listened to what he'd said during his campaign and since the election, he said in his campaign he was going to slap 60% tariffs on China. Tariffs, one of my new favourite words. Had you taken him at his word, you wouldn't be surprised by what's come about. Yet the market was clearly surprised by the scale of the reaction, because the market didn't believe what he said. So you're in a sort of really ironic situation that if you had an edge, the only edge you needed to have was actually believing what he said. Yeah. What kind of a mad world do we live in when that's the case? You actually believed what a politician said, and therefore you are ahead of everybody else.
I think more specifically, believing what Trump says has been quite a dangerous game historically, and that's why the market
hadn't believed
it. But I do think, there was a lot of talk before this event that Trump's benchmark on how he performs was the S&P and the NASDAQ. And he talks a lot during the campaign that the NASDAQ performed the best ever during his previous term, which factually is incorrect, actually, but he said it anyway. So our assumption was he's very focused on what market what US indices do. And for the moment, or for the time, for what's happened so far, is he appears to care less about those indices than we originally thought, and maybe we're at a level now. I mean, actually, you messaged me a few days ago and said you thought 5,000 on the S&P was the level where he starts getting twitchy. And we're there now, aren't we? Basically, so it'll be interesting to see.
Yeah, the market would. Yeah, exactly right. The market assumed that he wouldn't trash the stock market, but he has. He has. If we, we'll see. Time will tell. I don't. Yeah, but I mean, let's move on to some of the sort of economic impacts. I mean, we talked about iPhones and we talked about trainers. I mean, here's the official chart of inflation. People far smarter than I am have come up with estimates of US inflation set to rise mechanically 1 to 1.5%.
Yeah.
So currently 2.8, 2.9 in the US. Yeah. So getting up to nearly
talking about 4 handle, aren't we?
Does that? Because the flip side of this is that the economy is probably set to weaken in terms of growth as people put off decision making and the uncertainty takes its toll. What does that do for the Federal Reserve? And I mean, market has priced a few more rate cuts this year, but does the inflation?
Well, I think it puts them in
a difficult position.
A really difficult position because, I'm not sure. Say the Fed comes out with a 100 basis point cut to try and support the economy and the markets, which I don't think it would do. But if it did, I'm not sure it actually impacts markets too much because it's all about tariffs. But also it can't, I don't think it can cut aggressively because of inflation.
Yeah, and their mandate is to keep inflation down.
Well, they've got a dual mandate, haven't they, which is unemployment and inflation. I think it puts them in a really difficult position that, potentially they can't cut. And Powell historically has had a real focus on that inflation number. And when we felt, we've said it before in previous podcasts, we felt he was cutting too late. It was all around, inflation is, we don't want a repeat of the 70s and we won't be cutting until inflation's under control. But yeah, you're exactly right. The inflation is likely to rise under this tariff scenario.
But, inflation going up is another interesting point because a lot of the polling post the election in the US, a lot of the polling as to why Trump won and why Biden lost was that people absolutely hate inflation. Yeah. And like the eggs thing in the US is really polarizing. People just don't like a high price of eggs for the sake of argument, or milk or gasoline as they call it.
Yeah.
So Trump manufacturing, effectively creating inflation with these tariffs, he's almost making a situation that he benefited by, high inflation, he benefited by getting elected, making it worse again. So it's interesting. But no, I totally agree with the Fed. They won't be cutting rates aggressively anytime soon until they see, my best guess is until they see growth weaken or unemployment start to creep up.
And the other thing, a weakening dollar, they will be importing inflation as well. And I mean, this is a funny thing with Trump. He wants the US dollar to be the reserve currency of the world or to remain, but he wants it to be substantially weaker. And
I've got a chart here of the dollar actually.
That doesn't really work, does it? You can't, if it's a reserve currency of the world, you can't have it weakening dramatically.
So we'll put the dollar chart up as a 2-year chart of the dollar, and it had been very strong towards the end of last year and around the election. Yeah. And one of his policy goals has been to weaken the dollar, partly because he wants manufacturers, to export more, and a weaker dollar helps that. It did fall. It's not. I mean, I wouldn't say it's. So we'll come back, but so that's the dollar, and if we look at 10-year government bond yields here, we can see on the right-hand side of this chart, the darker blue line is the US 10-year and the lighter blue line above it's the UK 10-year. On the announcement, 10-year government bond yields did fall quite a lot because the market was worried effectively about a recession. Interestingly, in the last 24 hours, government bond yields in the US have spiked higher. There's a sort of bit of a story around today and yesterday that the Chinese might be selling a lot of their bonds, their US government bonds, and
well, they have positioned themselves quite smartly because they own about a third of outstanding US debt, don't they?
I think it's less than that now.
Is it? Okay.
They did own a lot, but I think
until yesterday when they transferred the
sold it all. But this happened a little bit in the pandemic, in the sort of the really bad days, is that government bonds sold off as investors just clamoured to raise cash.
Yeah.
And the equity market's already fallen. If you sold your equities, you're probably going to sell your bonds next. So I think at the moment it's a little bit too soon to say. Like the obvious parallel here is the Liz Truss budget, isn't it? When you had rising yields and a falling currency. We're not there yet, but I'm going to ask you, is this Trump's Truss moment?
I think it is.
You think it is?
I do. I think there's going to be a lot of US stakeholders and very powerful businessmen, business owners, business people, putting a massive amount of pressure. I mean, you've had some very well-respected financiers come out and just say this is absolute Armageddon. I think there's going to be more voices over the coming days because the US market, is set to open much weaker again.
Yeah.
There's going to be a hell of a lot of pressure on him of, this policy is not good for any of us. So, does it mean he is forced to step down or anything like that? No, I don't. Politics or the way a president is elected is completely different to the UK. Obviously, in the UK, a leader is elected by a party, and you can have a vote of no confidence. In the US, a president is voted for, so you can't. And to be honest, I'd probably rather have Trump in power than his vice president anyway. So I'm not sure that's that's an option. But I do think he's going to have massive pressure on him, and I think this could well be his lettuce moment.
Yeah, well, yeah, and if the markets carry on as they have done in the last 2 or 3 days, with bond yields going up, which they shouldn't be really, and the currency going down. That is very kind of Truss-like in how it happened. Whereas initially post-announcement, when the equity market first sold off, bond yields fell. Yeah. So we have had a little sort of change in environment a little bit. But I mean, it's interesting what you say. I don't know enough about it seems like tariffs is the one policy that the president can enact without any support from.
Well, doesn't it go Congress? Back to when he was made president? He said it was an economic crisis, and he under an economic emergency, he was able to sign certain things or to take charge on certain things. But yeah, I wonder, again, my knowledge of US politics is not good enough around that. But
you just sort of wonder where the checks and balances come in, and at what point we've already talked about prominent financiers, the likes of Bill Ackman, big hedge fund manager, or even Elon Musk's clearly. Pretty anti these tariffs.
I mean, there's been a big fallout in that sort of tech brotherhood, hasn't there?
Yeah,
which was always going to happen.
It was very much so.
But I think
when two worlds collide.
Yeah, I mean, 10-year treasuries spiking is a major issue because the servicing cost of US treasuries was already greater than the amount the US spent on their whole defense budget. So yield spiking means when they, when the US government issues new debt, it's costing them even higher levels than it was before. So this is a big issue for the US, and I'm not suggesting anything, any sort of default or anything like that, but I think, like trusts, when you see these moves in bond markets, there are lots of people voting with their feet, and they are not happy with the situation, and that does force change in policy or some sort of maneuver. I think that the really difficult bit is with China, because the Chinese certainly don't stand down, and I don't know, unless both sides come out and say they've won the battle and this is where they're agreeing. But they meet in the middle, but both will say they've won the argument.
You're into some sort of game theory type world, aren't you? And where's the off ramp, as the phrase is being used?
Yeah.
How do you step back from the brink? I mean, I think clearly it's not a war, is it?
No.
But it's,
I think, to be honest, China can probably hold out for longer because they can control their currency. And there's less wealth involved in the Chinese stock market, whereas the majority of US people have some sort of exposure to the US equity market.
I think I'll come back to bond markets in a minute, but from a bigger picture, James, one thing that sort of bothers me a little bit is that we've had 15 years, 25 years, 30 years of kind of US economic supremacy, and more of the world's capital, as we've already said, has gone into the US because that's been the best home for it. US equities have been the strongest, the dollar has been preeminent, the US is the global hegemon. I think that's the right word. Like, if you're, and I sit on the Tariff-ied investment committee, and there'll be firms like ours all around the world who manage money for people or for institutions, and we'll all be sitting here making decisions over where to put that money. Whether that's into European equities, UK equities, UK gilts, Chinese equities, Australian. Is there a sort of, feels like a very real threat to me that those committees start thinking, well, the US isn't such a happy home anymore for my money. They've retreated into themselves. Why should we have 75% of our equity allocation in US equities? Why don't we reduce it? Is there a sort of, like, I just kind of worry that we often overestimate the short-term impact and underestimate the long-term impact. And I just wonder whether the underestimating the long-term impact here of the US retreating into itself, and we go through a prolonged period where capital comes out of the US. Is that fair? Is that right? Or is that sort of a bit OTT, do you think, at the moment?
I think we're right to question it, because I'm not sure the world could have got any more positive on US equity markets than it was over the last few years, which is virtually, there's no point in investing anywhere else. So, and I think when people start to think like that, there's no sellers out there and everyone is trading in one direction. I would say, on the one hand, what the US has in its favour is it's got an incredible domestic economy.
Yeah, big economy.
Yeah, huge economy. It's self-sufficient in energy. It's not really reliant on, it is reliant on other countries. Part of the reason is for the tariffs, but in reality, it can produce an awful lot. And it is the richest country in the world. So it's also home to some incredible businesses that you can't match those businesses, or you can't invest in those types of businesses anywhere else. I think if there was a Microsoft, an Amazon, an Apple that was listed in the UK, it would be much easier to swing. But those companies don't exist. So if you want to invest in AI or future technology, you have to be in the US. I think, where it comes to other types of businesses, there are alternatives which I think foreign investors have forgotten about. I also think something that's been missed by the market, because the tariff war or the tariff announcement has been so big, is Germany's decision to move from 60% debt to GDP to 80%, with a big infrastructure spend, defence spend.
Really surprised the market.
Yeah, it's absolutely colossal, and that is a real game changing event that could have decade-long consequences of positivity. So I think...
So you put the two together, don't you?
Yeah. And I think those two together have potentially changed the future, certainly with a decade view, that actually, it's woken Europe up. Something had to happen in Europe. Is this the right way to wake Europe up? Maybe it was the only way that Trump, saying he was coming out of NATO and putting massive pressure on Europe, and now the tariffs, that actually Europe's going to have to be a bit more entrepreneurial. Maybe that was what needed to happen. But I think investors, for the first time in a long time, are going to look elsewhere in terms of their exposure.
And it's not even wholesale look elsewhere. It's where does the marginal additional dollar, euro, pound go? Does it go to the US as it has done in the last 5 years, or does it go to Germany, or does it go somewhere else? And I think that the change at the margin, we might just be underestimating the long-term impact.
Yeah, and I think I've had lots of friends that invest their own money or play in markets, and it's always been, well, we might as well just buy the S&P, and I think the dinner table conversations are going to be a bit different. It's actually
should be buying some Rheinmetall, the German defence company.
Exactly that.
I don't know. I think that's probably something that we're going to have to spend a few.
I think it's probably woken the market to the fact that no region is invincible. And I think some people had forgotten that there are other regions that are home to some very good businesses. You just need to be selective. And my view would be active management is more important than ever.
Well, the passive, the US makes up 70-75% of the world stock market. So the global passive fund is going to have a lot in the US, and that's been great on the way up. A couple of other sort of things before we kind of wrap up, because my phones and emails are probably lively. The oil price is absolutely cratered.
Yeah.
It's down about 25%, as this chart showed, going back 2 years. I mean, some of this is OPEC, and they are putting some more supply into the market, as far as I believe.
Supposedly
they're not
putting
quota
a deal
cuts.
with Trump.
Yeah.
Don't quite buy that.
This is quite good news for consumers, because higher oil prices act like a tax hike, or an oil price fall acts like a tax cut. Hopefully that will feed through into petrol prices in the UK, energy prices, etc., and obviously in the US in due course. But a massive move, and again, it's 6-7% today. Equities, and we've talked a little bit about why the stock market fallen. Well, the stock market's fallen because the stock market's worried about profits falling, because Apple's got to pay tariffs and things are going to cost more and demand's going to fall. If we look at chart here on the very simple valuation metric of the global equity market, this goes back 30 odd years. Equity markets typically trade on a valuation multiple of about 16. They had got to sort of 18, 19, and much of that overvaluation or that elevated valuation was because of US equities and the premium they were on. It's come back a bit, but not a lot. So equities still sit above their long-term average in terms of valuation. And if we kind of break that out into countries, difficult to see perhaps, but the red dots are the current valuation levels. The US still trades on about 20.5 times. Now, we don't know what the earnings yet are going to do, because we don't know how bad this is going to be. One of the fascinating things we've got starting this week is companies in the US are going to start reporting their earnings. So we get JP Morgan on Friday, which is always interesting. It's possible that because companies in the US typically give guidance as to how they think their profits are going to grow or not. It's very possible that US companies don't give guidance and say, we just don't know, particularly if you're a Nike or an Apple. It's very easy to say we just don't know because of tariffs. Profits could fall, and in a kind of worst case scenario, to come back to what we were talking about at the beginning, if you get a full-blown recession and corporate profits fall 10-20% perhaps, as they do in the worst of recessions, the equity market still looks quite expensive, and therefore there's
it does.
And that's not to kind of beat around the bush or alarm people, but equities are by no means cheap enough to withstand a release in a nasty recession, right?
No, I don't think a recession is priced in at this point. But also, a recession isn't guaranteed. So actually, the economic data was still holding up pretty well before this. Yes, tariffs will have an impact on earnings if they're held they're not renegotiated. But as you say, markets they're not on that very cheap level where you feel future events are necessarily priced in. I think
much margin of safety if things do.
I mean, it's certainly.
But if you look at the rest of the world, Europe is on 14 times, Japan 13.5, emerging markets 12, UK 12, China 11. So you'd say that those markets did have decent kind of margin of safety. So again, we'll see.
And it's important to point out that's why our allocation has been, how it is, because we felt, in some areas of the US, valuations had got slightly above themselves, and that's why we have that broader exposure. We do have a much bigger weighting to the UK and Europe than if you look at MSCI World indices, it's important for us to have that broad exposure. It's not just about the upside, it's about when things go wrong, trying to protect on the downside. If clients were 100% in US equities, these last few days would have been a lot more painful, but the last 2 years would have been a lot more exciting. So,
and then diversified portfolios are doing their job. Gilt yields are up a little bit. Okay,
correct.
Bonds as an asset class are holding their value.
Yeah,
we've got some cash, we've got some alternatives. UK equities are doing somewhat better. European, so I sort of look at portfolios and doing what they're designed to do. We are, we're not immune by any stretch, but we are hopefully riding out the storm. And then if you want to put this chart back up, Alex, the emotional roller coaster, just to finish with. And
where are we here then?
Where are we here? I think we're in elements of panic and capitulation.
Yeah.
I think some of the moves have been pretty big, and you tend to get these kind of massive sell-offs, deleveraging, funds just having to sell to raise cash. That typically capitulation.
Yeah, I think it's flushed out. A lot of the levered holders will have been flushed out in this, and that's why you had these exaggerated moves. I think the despondency bit hasn't happened.
No, and then as I said earlier, that can go on for a while. That despondency piece.
Yeah.
I remember 2008 and like the Lehman Brothers day, and then the sort of few weeks after that was definitely the capitulation. Yeah. But the market didn't actually bottom until the following March. You had another 6 months of kind of bumbling along. Yeah. Which was quite painful.
And I think that's when you can get some more selling when clients and investors think, actually, this is never going to recover. What's the point? And that's the despondency feelings. Yeah. And when investors and you personally start feeling like that is the time when
time to load up.
That is the time
to load up. Hopefully we get this, because in 2020, of course, we never really had an elongated period. The markets recovered quite quickly. So again, that could happen this time just because of the nature of this event.
Because it's a binary event.
It's binary. Yeah. So, I don't know what messages we really want to leave other than kind of strap in, don't do anything stupid.
I think because the situation is fluid and it can change so quickly, trying to position for these tariffs and work out which companies are more exposed or less exposed, and chipping away at equity holdings to hold cash for the short term, hoping that there's a worse day. That is a dangerous game, because we could wake up and a deal's been done, and the market won't wait for you. I mean, on Friday there was a rumor of a 90-day.
Monday, wasn't it?
So was it Monday? There was a rumor of a 90-day pause on tariffs, and the market flipped 8% in 5 minutes. So you won't have time to, no one has time to get back into the market. The computers, unfortunately, are much quicker than fingers typing on a keyboard. So, the markets move much quicker than they ever have. So it's about being invested in a diversified portfolio of great companies, which is what we do for clients, and it's about sitting it out at the moment.
Yep. Totally agree.
That's the message. Time in the market, not timing the market.
The other thing I would say is, as I get a bit older in these things,
you are quite old.
Thanks, mate. And it might sound a bit twee, but like not to bottle it up. So if you're kind of worried about this stuff, just talk to people around you. Just ask how you feeling about it all. It does make a big difference.
Yeah. Yeah. Or get on the phone to your investment
WhatsApp
manager.
Groups are pretty lively, aren't they?
Yeah. The memes are running through.
The memes are going well. Yeah. So so we're recording this Wednesday afternoon. Probably should have said that at the beginning, really. But hopefully we'll get this out pretty quickly, and hopefully it'll still mean something by the time it hits. If not, we'll send some sort of follow-up email and we'll re-record. But we're back on next week. Talk about we've got another guest lined up for this time next week, so we'll look forward to that.
Yep.
And in the meantime, everyone, thank you for watching and listening. Hope you've enjoyed it. Any questions, get in touch with your usual financial advisor, investment manager, james.hughes@quiltachieved.com, and I'm jonathan.raymond@quiltachieved.com. And we hope to see you next time. Thanks very much.
Thank you.